You can't control the Fed, you can't control inflation, but you can prepare for what comes next.
Yeah, I know. It's an interesting time, right? There's a lot of people hanging on these quarter points. And I know Powell came out last week and said that there might not be another rate cut in December. So that kind of threw the markets in a tailspin, actually had rates go up a little bit. And I think Danilo and I started talking and we're saying, it's important to watch, but it's not that meaningful on the big picture. And I think, there's a lot of ways that people make decisions. And, if you're, an analytical or empirical type thinker, then for sure you're all over this stuff. And all it means to you is read and stop, right? So I think today we wanted to just get into, how we look at the markets in general, go up maybe up to about 30,000 feet. And maybe look at it a little bit differently, because sometimes you get caught in these cycles of analysis paralysis, and you're hanging on every word, every quarter point, and you're trying to time things perfectly. And if you try to do that, you just basically stop and you don't really do much at all. So, Daniil, what are some of the things that you're seeing?
Well, before we even get into that, I would just say, you have to remember, the news makes money on clicks, YouTube makes money on clicks. So when people are talking about crashes or they're talking about, all these terrible things, that it gets more traction than just data-driven things. Like, people have to look at the data. You shouldn't even listen to Ken and I and make decisions. You have to dig into the data. You shouldn't watch a YouTube video on a crash or watch the news saying that, foreclosures are up or whatever, and make your decisions based on that. That's all good data, but that's not really data. Those are just headlines. You have to dig into the actual data. And that's some of what we're going to do today. And we're going to also talk about what MC Companies is doing and what Ken is doing, because that's important too, because they're making their decisions based on the data, and it's real information, not, catchy information.
Yeah, we call it just controlling the controllables, right? There's so many things you just absolutely positively cannot control.
Mm-hmm.
But if you look at the math, and I say this a lot, it's just math, right? So
Mm-hmm.
whatever is going on with unemployment, whatever is going on with the interest rate, whatever's going on with the housing supply, whatever's going on with inflation, it all means something. It's a recipe for you guys to make decisions. And these little moves, all they are reasons or distractions away from what could potentially be a bigger picture for you. And so, so I'm just going to go back and tell you, just give you a kind of my snapshot over the last few years. When money was really cheap, and I'm talking about interest rates, which is what everybody wants again, it becomes really, really hard to buy because everyone's jumping in and buying and driving the prices up. That's what happened in 21, 22. Then you guys saw the inflationary effects. Now that could be for all kinds of things. A lot of people blame that on the pandemic and the stimmy checks and all that stuff. But whatever it was, it went up to 9.1% inflation, and then they started to increase rates. And what that did was that exposed a lot of people that thought everything was going to be the same next year. And I think that so I get the fact that everybody's kind of afraid that that's going to happen again, but there are some very basic controllables that you don't have to worry about that. So, for example, the real simple one is just fixed rate debt. If you guys know what your interest rate is and your payment is today, wouldn't you want to know what it is in 4 or 5 years from now? And that's it. That's what actually got everyone in trouble. The irony is most of these deals that people bought are actually performing. They're actually performing. The rents have not gotten smashed too much, although in some markets it's that way. Certainly expenses are going up, but they always have gone up. Ever since I've been in this business, we've been battling expenses. So, yes, the market's different. I get it, but it's different for a number of other reasons. And so I think, we always say, don't try to time things. That's what's going to drive you nuts. Well,
Yeah,
you
this
guys,
isn't like, it's not like a
right?
stock. You're not trying to time it. You're not trying, it's not like crypto. It's not gambling. It's just, it's a long term. That's what I always tell people. If you're holding this for 10 years, you and I went and looked at the data every decade over the last, 70 years, housing has significantly went up, including the Great Recession decade. So people try to time things, and that's what drives them crazy versus just, trusting the process and getting that fixed rate debt.
It's okay if you guys buy something and a renter's covering the payments and you're getting cash flow. It's okay if the value of that house or fourplex or apartment project, or it's okay if that value actually goes down. It doesn't matter. Like, it happened to me in 05, 06, 07, 08. And right now it's happened again. My net worth went down a lot when the market's corrected, because everything was based on a really hot market with a really low cap rates. Well, cap rates are a little higher, interest rates are a little higher. That's okay. Who cares? It's fake equity.
What's funny is, so I was, my one client just bought an $850,000 house, and I was driving around that neighborhood, waiting for her and checking out the house and everything. And, the cars in people's driveway. So all their homes are worth right around, let's call it $800,000 to $900,000. You have old cars in the driveways, all these different things, right? These people could never afford an $800,000 or $900,000 house right now. They probably bought these houses for $250,000, $350,000, 20 years ago, right? And when you look at that, that's the piece that people miss, right? Because they're so focused on, if I buy this and it goes down, like, I want to get the best deal I can, so I'm just going to wait. I'm going to wait until things go down because I can't bear to have the house and then it goes down. Well, guess what? A lot of these people in this $800,000 and some neighborhood probably, went through the Great Recession, probably watched their home prices go down, watched their home prices go up. But at the end of the day, as long as it's cash flowing, or if it's your home that you can afford the payment, like, who cares?
I'll tell you a funny story. Everybody kind of knows me as the real estate guy and whatever. Ross and I have not gotten everything right. Like, we bought a bunch of stuff at 05, right? And it went down, and then we bought some stuff in 2021 and 22, not much, not like everyone else, and it's down. And then one of the funniest stories was my personal home. I built it, right. I remember I broke ground in like 05, 06, and I went right into 07, 08, right into the great financial crisis. And so I actually built the home, and the home was actually worth less for years. But it didn't matter because I was raising my family in it, paying the mortgage. I had a really, really good rate at the time. It was a construction to perm rate. I think it was under 3%. I since it's paid off. But the point is that home, I still own it, actually, 20 years now. It went up, it went down, it went up, it went down. And I just didn't care, and eventually just, if it's covered, and that's the key. If you have a property that you paid 500 or 600 or 700, and it's gone down 50 grand, but who cares if the renter is still at $2,500 or $3,000 a month and paying everything and you're getting cash flow? Who cares? Because this is a long game, and I think that's actually the mentality we need to break people out of. Is they're trying to time this like a stock. This is a long-term business that your tenant is going to pay down for you. Your tenant is going to pay this off for you. And that's how you need to look at it. And you're getting massive tax benefits, and you get cash flow. Too many people are focused on the actual value. And trust me, I get it. Nobody wants to buy something and have it go down. I get that. I completely get that. But what it does is it actually stops people in their tracks.
Mm-hmm. And that's the bad part of it, right? Like, I bought something in 2021. I think it's down like 20 grand or something. But in that time frame, I mean, I think I've collected $70,000 in rent. You know what I mean?
Yeah.
So you have to, weigh those two factors against each other.
Yeah. And it's interesting because I was actually, I'm at a conference right now in New Orleans, and I'm down here with Robert Kiyosaki. We're having this great discussion on the plane down here. And it was all about proof, right? Like proof. People need proof to make decisions, right?
Mm-hmm.
I completely get that. But there's what is it actually makes people decide to make a decision, right? And you get the far side of it where they're kind of spontaneous and fast. That is not the right way to make a decision. On the other side of that is overly analytical. You have to be somewhere kind of in between, kind of like a little bit intuitive, where you're following some patterns. You're actually flushing out what you believe might be true, and then you're gaining proof, because I think too many times proof without belief is empty. But the thing, so you have to kind of have to get that over time, and you get that by not being spontaneous, by being a little bit visionary, by taking a look at the markets, taking a look at the patterns. For example, Jerry, let's take a look at the floor, because I think this is a very interesting. This is the first-time homebuyer chart. This is proof, and so let's just take a look at this, guys. These are the number of first-time homebuyers in the last 20 years. Now, I just want you to look at that graph. Obviously, it's going down. That is not good. It's way below the 20-year average. Okay, so that is proof. That is actually empirical data for all you analytics out there. And so what does this mean? What this means is that we have an affordability problem. That's what that means. And so, there's a way to look at this data, and there's a way to pull the trigger. And we already know, guys, that the U.S. is severely undersupplied based on what happened in the last 20 years, because the great financial crisis took the wind out of the economy for almost 10 years. There wasn't a lot of new construction. There wasn't a lot of new supply. So those are two things that are empirical data. But even with all these kinds of things that we look at like this, Danielle, people don't make decisions, right? They kind of wait, and they want to time this at the bottom, right?
Yeah, they treat it, like you said, they treat it like a stock. They treat it like, and it was interesting because I believe it was Josh said he doesn't care if the property drops because he's not going to sell it. So he's not going to realize that loss. And at the end of the day, I think that's how I feel too. I mean, I don't really keep a lot of, close data on what my properties would sell for if I were to sell them today, because I'm not selling them, so it doesn't really matter to me if they would sell for less, because, I'm kind of, you can't have buyer's remorse like that. I mean, you can't try to time it, because what happens is people try to time it and then it goes up, and then they're like, well, now I got to wait for it to go down even more, because there were so many people that wanted to buy up until 2019. And in 2019, they were saying prices were going to drop too. And then 2020 happened and rates went down and home prices spiked. Well, Trump keeps talking about how he wants rates down next year. So what do you think home prices are going to do?
Yeah. Well, guys, I'm telling you, we just went through this. I've gone through this multiple times. When rates go down, cheap money enters the system and creates asset bubbles, period. That's what happens, right? So this is the time. Now, by the way, rates might not go down, but I know Powell's only going to be around until May, and then Trump's going to have his own people in there, I guess some of them at least. But the point is, there's an affordability problem now. There's a supply problem now. People can't afford a home. We know this. Inflation is, who knows what's going to happen there. But even the Fed is having a tough time with that. I think it's up at 3% now. It's going back up. And unemployment. So all of those things are up. And so what do you do in that scenario? You look at the empirical data and you say, I think that more people are going to actually be renting than buying, just like the chart shows. So if that is the case, then you can make a calculated bet that housing is going to be in demand, and the right kind of housing in the right place, in the right markets, and all that kind of stuff. And we're not going to get into that now. But obviously, you want to try to buy where people are moving, right? and they're moving for all kinds of reasons. And that's another live or another podcast at a different time. But the point is, you're trying to look at the data. Where are people going? Is there a shortage of housing? And you want to be on the right side of it. You don't want to be a pioneer at all. You don't want to blaze a trail. You want to let somebody else go before you and let it get proved out, and then look at the data and then be there, be part of the river flow. Don't be swimming upstream and trying to create a market. That is not what we're trying to do here.
Yep. Well, and let's go over just, some of the things that you can control, right? So we just talked about all the, how you should feel about things, but there are things that you can control. And one of the big things I think is your underwriting assumptions. And I do see people making this mistake right now is they are trying to write deals assuming rates are going to go way down next year. And I'm not sure that that's the right way to write a deal currently.
No. Come on, like, who could bet on that? The only way to write a deal is, does it cash flow today at today's rates? Period. Right? I told my entire company at our annual event 2 weeks ago. Well, not but half the company. I said, I don't expect that 2026 is going to be better than 2025. I said, we're battling expenses and rents are going to be flat, even negative in some cases, based on all this supply that just hit the market. Because in my world, we just had over 500,000 apartment units hit the market. Now, they're all over the place. Dallas, Atlanta, Nashville, Phoenix. That's a whole different story. But the reality is supply is hitting. Tenants have more choices. The markets are soft from a renter standpoint. So what does that mean? For me, that means it's time to buy, because I've tried to buy from the person that's struggling with occupancy, that has flat rents, that has high expenses. Now, I am also in that category. I own stuff. So yes, but I'm not selling those. I'm just trying to manage those the best I can, but I'm also trying to buy and load up during this period of time, because I also know that these things are cyclical.
Yeah, and that's the biggest thing, is trying to look more into the future. I know that, I'm going to be doing a 1031 next year, another one. And it's like, yeah, I could have done that in the height of the market, but right now is the time. It's a buyer's market. People don't realize what a big deal that is on apartments and on residential, right? And because of that, you have more negotiating power. So people look at it as like, oh, it's a buyer's market, so now the market must crash because the buyers are in control and nobody's buying houses. Well, guess what? That's not true, because I'm working with buyers and I'm seeing stuff that we're going to look at. And it is going, as long as it's priced correctly, it is going quickly. And it wasn't over, a few months ago. So now, because people are anticipating rate drops and people are, trying to move their money into inflation protection, it is going. And you know what? A lot of these deals are still going cash, just like they were in 2020, 2021.
Yeah. And I'll tell you, I'm down at this gold conference down in New Orleans right now. And it is buzzing, right? Like, because it's all alternative investments, right? Which is why I'm here. This is the first time I've been. I'm here as a participant, walking around, trying to see, where is the world heading? And it's actually a perfect time to recognize our sponsor, Monetary Metals. So, Jerry, let's do that.
They're all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
So based on this market, how should somebody be negotiating or deciding on how much they're going to pay for a deal?
Well, For us, it always starts with the cash flow. So if I'm going to be pulling money out of a savings account or maybe another property, that's we call that imputed equity, let's say. So whatever equity you have, it doesn't really matter where it's coming from. Maybe you're getting rid of a stock and you're selling that, and then you have equity. Maybe you're like in Danielle's case where you're doing a 1031, or maybe it's in savings. It doesn't really even matter. But the equity, where that goes next, what kind of a return does it get? So I'll give you an example. Last night I was talking to a guy at this conference. They're doing micro loans. They're actually, he told me that he would give me 26% on my money. Now, of course, I've got to check it out. I'm not advocating you invest with this guy because I just met him. But the point is, that is a return on equity. So it's not in real estate, by the way. So now you start to look at what and where do you want your equity. And so for every single decision that I ever make, it always starts with that. The property is actually the vehicle. So does the property produce 6, 7, 8, 9, 10% cash on cash or not? And if it doesn't, do I pass or not? I don't know. Maybe it's a value add. Maybe I'm buying it below replacement cost. I'm getting the tax benefits, so I got to work that all in. So it's a really complex question, but at the end of the day, I'm always solving to my imputed equity. That money that's sitting in your home, let's say, like my mom. I always bring my mom up. My mom, obviously, she doesn't own anything on her home anymore. It's worth $700,000. She's got $700,000 of imputed equity there. She's just fine. She's not going to mortgage it. She's not going to do a cash out refi. She actually doesn't even care if it has a return on it. When you're younger, you might have a little different perspective.
It's also a good store of value. So, one thing that we know is inflation is going to continue to go up. I mean, you guys can research that. It's happening all over the world. And hard assets are a great return for inflation because they tend to move with inflation. So you know that. That is something that you physically know. So buying a hard asset, it probably is going to go up over time because with inflation, it's going to be more expensive to even build it.
Yeah. So the cash flow discipline is number one. And wherever you're moving your money to, you start there. Does it have a return or not? And you guys, I talk about this all the time, but I don't know how many deals we say no to every single week. It has to be way more, right? I don't know the percentages, but my guess is we probably look at 1 out of 50. And we probably say yes on 1 out of 100 plus, where we actually are making bids on. So, your underwriting kind of flushes all that out. It all has to start with cash flow.
Yep. And right now you're buying things that are under replacement cost in your own portfolio.
Yeah. So that's what we just put a deal in Vegas in escrow. We're buying it at basically what it costs to build it. Which means somebody somewhere lost the equity. We did the exact same thing on another property that we bought there. We bought one in North Scottsdale. These are all just a few years old. The one we're buying right now, I actually haven't seen it yet. Ross flew up there last Friday and took a look at it. I plan on going up in the next week or two. And it's a brand new building, absolutely gorgeous. And so why would we do something like that? Well, we get to eliminate all that construction risk, the purchase of the property, all the entitlement work and everything that you have to do with the city of Las Vegas, and then managing the contractors and the subcontractors and all that stuff and getting all that stuff. That's like a 2 to 3 year process. We get to step right in and buy it for basically what the construction loan was, because this person is a little bit overextended. They have too many of them going on, and construction debt went up during this period of time, which we all know. Rates went up, and construction loans are floaters. So, so we're stepping into that situation. And ironically, it's not a great cash flower today. It does cash flow for sure, but it will grow up over time. But but we're buying it below replacement cost. So we probably have a year to 2 years of, hard to manage operational just to keep the cash flow as high as we can based on market conditions. But that's realistic. That's how we've underwritten it. But then after that, if you look at the numbers, which you should, construction drops off a cliff, and we're going to get back into an affordability problem again, specifically with the renter. Right now, the renter has the upper hand, and which is just fine. They've had a rough one, but that's all going to change again. And the only thing that changes it is supply. You guys, you want prices to come down. So what everyone wants is they want low prices and low interest rates. Those two things don't work together. Low. I mean, they can for a while, by the way, and that's you want to buy in that little window, and that's the window I think that we're heading into.
Yep. Except people aren't going to believe that home prices are low right now until 10 years from now. Nobody believed home prices were low in 2019. Nobody believes it now. The average, we had friends in from Canada that we were chatting with. And what's the average home price in Canada? Something?
It's close to 800. Yeah. That's the average, by the way, guys. Like they were from Toronto, like 1.2. I think one guy was from Victoria. He was like 1.5 million is kind of a normal home. Vancouver, all the big cities, really, really high.
They couldn't believe.
Some of these rural areas in Canada, which you guys probably never even heard of, those are expensive too.
Well, he couldn't believe that you could get a starter home in the Phoenix area for $500,000. He couldn't believe it. And out here, we're like, oh my God, $500,000 for a starter home. He couldn't believe that it was that cheap.
Yeah, because they're not down here to do that. They're actually trying to buy mobile home parks and RV parks. Yeah, and that's what we're talking about. The other thing up there is they have a 5-year mortgage. Like you guys, like we're spoiled down here. We have these 30-year mortgages. Danielle was saying that she has a condo that's 2.6. Your interest rate on it?
2.6. Yep.
Yeah, and he's like, what?
And he couldn't believe it. He goes, but not for the full 30 years, right? And I said, yeah. He goes, really? Like he just couldn't believe that it was that low for 30 years.
We're spoiled down here. We just don't know it.
Exactly. So I want to talk to you about, fixing, debt, right? Because right now, everything that you guys are doing is fixed rate debt. Everything I'm recommending people do is fixed rate debt. And I know it can get enticing because adjustable rate debt can be lower, but that's not, and people assume that rates are going down, so they don't see the downside of it. But that still is a risky assumption to take.
Well, I guess what's the downside for fixing if you think rates are going down? Okay.
Well, because I think people, they want to save money monthly, right? Like if I just do an adjustable rate for a year and then I can fix it lower.
Yeah, the banks are tricky, man. Like they offer you better rates on the floaters, and so what you're giving up, to me, the insurance policy of knowing what your interest rate is going to be and what your payment is going to be is trumps everything for me, because that is a controllable. We're going back to controllables, which is kind of how we started. What's controllable? What isn't controllable? And interest rates are controllable if you fix them. And of course, the cash flow is controllable on how you manage a property. If it's vacant, if it's not vacant, if you know how to do that, it's somewhat controllable. And so I don't like I don't like moving to will rates go up? Will they not go up? And by the way, if we have high inflation, rates could go up. So, for me, I'm hedging the up. And I'm refinancing the down. So Ross and I did this already 20 years ago. Everything was fixed. And as rates went to zero, we're like, holy moly, like this is so great. We just kept refinancing on the way down. And so our payment was actually we were taking money out of the properties. Our interest rates were going down and our payments were going down and our cash flow was going up. It was awesome. So if you can make sense today, it'll really make sense tomorrow, especially if rates go down. And then you'll look like a genius if they go up. So, it's just, to me, it's just a higher degree of certainty.
Yeah. And I think, the people on the residential side that are, getting into this are people buying from the builders, right? Because they're doing, the loan concessions for, 1 or 2 years. And then they're being told that, once this concession is done, you're going to be able to refinance for a lower rate. And while that might happen, it might not. So you just have to be sure you can afford the regular rate if it does not happen.
That's it. Yeah. I mean, that's a blessing. If you can get a lower rate and you can afford the higher rate, then by all means do that. Like it's funny. I usually pay cash for cars, right? I have no debt on any of my cars, and I've been doing that forever. But the point is, one time I went into a Range Rover and they were doing a 0.9 or something, or it was like less than 1% to finance it. And I go, are you kidding me? I can actually, that's way below inflation. So I just did it, and then I paid it off later, but I was like, okay, might as well finance this, because the cost of money is important. And so, if obviously like Danielle's condo, the struggle she has is that she's got a whole bunch of equity and a 2.6% loan.
Yep.
Right?
Yep.
Drives her nuts. It drives her nuts.
Hard to walk away from, but I would like some of the cash, but yes.
Yeah. So, but I think a lot of people are in that situation. They want the money. And the issue is, if you really slice this up, the issue is that she's walking away from a loan that's actually below inflation.
Yep.
And that's actually a huge thing. Inflation is going up faster than she's borrowing. And so, yes, so what do you really get by taking that money and moving it into a 6% loan, right? There are costs. Yes, you have access to the money. Maybe you get to buy something more, but you've now doubled your payment on that piece that's left on your loan balance. And you've gotten toward that imputed equity, let's say the equity that you've got in there. But at the end of the day, there's also a cost. And if you sell it, you actually have a capital gain as well. If you 1031 it, you're going to roll right into the market today with, let's say a low 6 or 6.5%. So that's a 4% is a huge difference from where she is. And so there's a lot of people that are sitting in this situation right now.
Yep. And let's talk about operational control, because I know that you're big on that at MC Companies, and I'm seeing a lot of small landlords make these mistakes right now with these small rent increases and losing their tenants over them.
Yeah. This is the year of the renter. And by the way, I'm talking about next year. So, this is a time that if you don't have a great relationship with your renter, this is your time. You need to make sure that you have a good relationship with them. This is your time to maximize income and through high occupancy. And so a little bit of a rent increase can, think about that. Maybe you're trying to increase them $25, $50, maybe $100. That one little bit that you're trying to get, you can lose that in just a week or two of vacancy and turnover and marketing and all that stuff. So this is not the time, this is not the year to start jacking rents. And that's on occupancy. On the other side of that, this is also a time to really dig into your operating expenses. And there are a number of ways to save on those as well, from utilities to property insurance to property tax to how you're buying and all that kind of stuff. So, this is the time. I like this time. This is, I grew up in property management, so I'm used to these periods of times. And what will happen is the poor management is going to get exposed, which is also going to create a number of opportunities for people that are buying.
So the biggest thing I think right now is you need to turn off, the noise, and you need to actually look at the data in your area. What are your local rents? What are the job trends? And really, I encourage all of you to find houses in your price point on Zillow and watch and see how many days on the market those houses are listed, because I think you can't really get a real gauge for your market unless you do that.
Yeah. And I know it's funny because I know Danielle is more on the single family side, but she has people that watch YouTube and read headlines, and they think that they have time, and then they look at something and it's gone a week later.
No. I had
right?
a client. Yeah, I had a client last week. I took her to see 7 houses. She loved 3 of them. She wanted to wait, and she had some reasons for it. And then next week, she goes, "Okay, I want to kind of offer on one of those 3 houses." I said, "They're all sold." She said, "What?" I go, "They're all under contract, every single one of them." And she couldn't believe it. But the truth is, that is what's happening in our market. It's not what's happening nationally.
Yeah.
Every market's different. But in our market, in a desirable area at a good, decent price, things are moving.
And we're not saying to rush out and buy, guys, at all. Period. What I'm trying to tell you is that's actually empirical analytical data. So, take a look at your days on market. Take a look at what's going on, the behavior of the buyer and the seller, that, and by all stretch of the imagination, is not necessarily a healthy market. If something gets listed and gets sold inside of a week or goes under contract, that actually means it's still a little bit of a seller's market. Now, there are areas, even in our market, that are not like that.
Yes.
And then, this is one particular house, one particular market.
It's area to area, right? I mean, it's block to block. That's why you need to understand where you want to buy, and you need to follow houses in your price point in that area, save them on Zillow, and then look at them, every week or whatever, and see how fast they're selling. And then you can gauge too what the price point is that you should, it helps you understand what the pricing is in the market as well. And I can tell you, back in April, every house had 1% to 3% concession. Now, I'm not seeing that at all here. So I'm not seeing the concessions at all.
That means it's tightening up, but maybe it's because of the last 2 rate cuts. Who knows? But things are moving a little bit more. When Danielle and I bought a house a little over a year ago, it was on the market for 260 days.
Mm-hmm.
I mean, that's a long time.
Mm-hmm.
And that was 1 year ago. So now, different price point, different situation. But I'm just saying, different markets have different nuances, and just understand them, and then you'll get a better sense of when you need to come in.
Yep. And you just have to control what you can now and understand when rates do drop and everyone floods back in, that is not a great time for you to buy. You have to understand that you kind of want to be doing opposite of what everybody else is doing in a lot of circumstances, because that's going to have bidding wars. You're going to have no negotiating power, and the sellers are going to have the power again.
Guys, listen, as rates come down, people are going to unlock that trapped equity. There's going to be all kinds of movement. That's what low rates do. Low rates get things moving. And so, everybody wants that, but they also want the low price, so that's why this is a good time. If rates go down, and we don't know if they will, because there's actually some uncertainty. If unemployment continues to creep up and we start to see inflation, it's possible that rates are going to be neutral through next year. Very possible. And that's the way you need to be thinking. And so just make sure it cash flows today, and then don't worry about it. If they go down, great. You look like a hero. If they go up, great. You look like a hero. You're like, okay, I'm glad I locked in at a fixed rate, and you didn't get caught in that floating game.
Absolutely. And then, you have to remember, the biggest wealth transfers happen when things feel uncertain. And right now, things definitely feel uncertain, because you look back in the past and you're like, oh, if it was 2010, I would absolutely have bought something. Well, guess what? People didn't, because you know why? They thought that it was still overpriced, even though it was dirt cheap. You know what I mean? So,
I went through that period.
Mm-hmm. Yeah,
that's when I made all my money.
Yep.
You're right.
Yep. Yeah, people, or you can't get lending because the banks tighten the lending. So even if you do want to buy, you need way more down, and they have much more stringent lending criteria. So you have to understand that when everyone's doing something is not when you want to be doing it. It's when nobody is doing it, or they're afraid to do it, where the opportunities are.
Yeah, and that's tough to do. It's just because the herd mentality kicks in, right? Oh, this person, I remember I was when things were running. And I was at Target picking up some stuff over Christmas, and the checker, was this young gal. She pulls out her real estate card. She's checking me out at Target. She hands me the card. She said, "Hey, if you're interested, in this market, I'm also a realtor." And I walked out to my car. I said, "It's over. It's over." You know, that,
Yeah.
and it's just like, it's pretty common sense, guys. Like, when there's a lot of people doing a lot of stuff, there's a frenzy, there's a feeding frenzy. And when it drops and everybody's like, it's crashing, it's crashing. It might not be. I'm not seeing a crash. And it's a down dip based on people's reality of, 4, 5, 6 years ago.
Yep. All right, guys, we will see you next week. Make sure you check out our podcast. It's on Thursdays. It's the Ken McElroy Show on, Spotify or any of the podcasting apps.
All right. See you guys. Cheers.